Hey everyone, this is the Loan Officer's Mortgage Market Update. The goal here is simple: to give you a clear, consolidated view of what's actually driving rates right now, so you don't have to spend hours digging through headlines and reports. At least once a week, I'll break down the key economic data, what it means for where rates may be headed, and most importantly, how you can use that information to win more business in today's market.
Here's your mortgage market update with a focus on what actually matters for loan officers in the field. The big story this week is that rates got a little relief, but the market is still dealing with two competing forces: easing bond yields and rate sheets on one side, and a fresh inflation spike on the other. Freddie Mac's weekly survey showed the average 30-year fixed rate at 6.37%, down from 6.46% last week, and Mortgage News Daily had the daily 30-year index at 6.38% on April 9th, down from 6.44% on April 7th. Now, here's the part the bond market is trying to sort out. This morning's March CPI report came in hot on the headline number. CPI rose 0.9% month over month and 3.3% year over year, mainly because energy surged, with gasoline up 21.2% for the month. But core CPI, which strips out food and energy, rose only 0.2% for the month and 2.6% year over year. That is important because it tells us the inflation problem is still being driven more by the energy shock than by a broad-based reacceleration across the whole economy. From a rate watch perspective, that means the market still has to respect inflation, but it also does not necessarily have to panic and assume a new long-term inflation spiral. The Fed's daily H15 release showed the 10-year Treasury at 4.29%, the 2-year at 3.79%, and the 30-year at 4.89% on April 8th. On top of that, a Reuters poll published April 9th found most strategists still expect the 10-year Treasury to be around 4.26% over the next 3 to 12 months, even after the recent geopolitical volatility. In plain English, the market sees near-term turbulence, but not necessarily a permanent breakout higher in long-term yields. So what does that mean for loan officers? First, this is not the week to market yourself as a rate predictor. It is the week to position yourself as a payment strategist. Borrowers do not need a macro lecture. They need clarity. Show them the difference between today's payment, a seller-paid buy-down payment, and a wait-and-see payment. In this market, the LO who wins is the one who turns volatility into options. Second, purchase business is still where the opportunity is. MBA's latest survey showed overall applications down 0.8%, but purchase applications were actually up 1% week over week. FHA purchase applications were up 5%, and MBA specifically noted those loans are benefiting from FHA rates running about 30 basis points below conventional. ARM share also rose to 8.6% of activity. That is a strong signal. Product knowledge matters right now. FHA, VA, and the right ARM conversation can absolutely help you create transactions that a plain vanilla quote cannot. Third, your realtor conversation should be getting sharper. Scotsman Guide reported that newly pending listings in March were up 4.6% year over year and nearly 30% month over month. Active inventory was up 4.2% from a year ago, and 22.6% of listings had a price reduction. That is your opening. This is the environment for calling agents and saying, I can help your buyers use concessions, buy downs, and product mix to win in a market where sellers are getting more flexible. That is a much better conversation than, let me know if you have anyone who needs financing. And finally, stay encouraged. Yes, the market is choppy. Yes, inflation headlines are noisy. But a market like this rewards skill, it rewards speed, it rewards follow-up, and it rewards loan officers who know how to explain the numbers calmly and turn them into action. This week, I'd be making 3 plays. Call your active pre-approvals, rework every marginal file with FHA, VA, or buy-down scenarios, and reach out to your top agents with a simple message. Inventory is improving, sellers are cutting prices, and I can help make more deals work. That is how you build pipeline in a market like this.
If you're a loan officer and you're looking for a better way to navigate this market with stronger tools, better systems, and real support to grow your business, reach out to me. I'd love to show you what we're building at Central Coast Lending and how it can help elevate your production. My contact information is on the screen, and I'd love to hear from you.